across a tightrope, suspended thousands of feet in the air.
Okay, I am picturing it. Sounds terrifying.
Right. Only, this isn't a normal tightrope. The rope itself is woven together out of fragile global oil pipelines and, like, microscopic silicon chips.
Oh, wow. And let me guess, the wind blowing you off is the Federal Reserve.
Exactly. That is the wind that just keeps violently threatening to blow you off into the abyss.
That is a terrifying visual, but honestly, it captures the exact psychological state of anyone allocating capital right now.
Yeah, we all love to think that financial markets are driven by clean, predictable spreadsheets, you know.
Right, rational discount models. But lately, you and I both know they are driven by this chaotic, visceral tug of war between geopolitics and monetary policy.
I mean, the math only works until a missile flies or a central banker walks up to a microphone.
Exactly.
Welcome to the Deep Dives Weekend Recap. I'm Daniel.
And I'm Mira.
Before we step out onto that tightrope together, we need to lay down a quick disclaimer for you.
Right, good call.
Everything we discuss in this deep dive is strictly for market context and educational discussion. It is not personal investment advice.
Yeah, and it is certainly not a recommendation to buy or sell anything.
Our mission tonight is to set the macro backdrop for you as we head into the new week, starting Monday, May 25th, 2026.
We are going to untangle the incredibly dense web of geopolitical news that hit over the weekend.
And ultimately, we want to unpack why the S&P 500 keeps pushing higher even when interest rate and inflation anxieties are just flashing bright red.
Well, let's get right into session one. The question we have to ask to set our baseline is, what drove the market's movements over the past week?
So if you look at the trading window from Monday, May 18th to Friday, May 22nd, it was fundamentally a story of surviving a massive scare.
Yeah, and then experiencing one of the most aggressive relief rallies we've seen all year.
The price action was wild. I mean, we had a pretty nasty dip early on, with the S&P 500 bottoming out at a Tuesday close of 7,353.61.
There was real fear in the air.
There really was. But then, institutional buyers just stepped in with incredible force. We ended the week on Friday, pushing up to 7,473.47.
And what was fascinating to watch was how that structural resilience just utterly crushed volatility.
Oh, totally. The VIX was dragged all the way down to 16.7.
Right. And when you look under the hood to see what actually catalyzed that equity rally, you can trace it directly to a total collapse in crude oil.
The energy market was the lever moving everything else.
Exactly. WTI crude fell from an opening week level of 108.66 down to settle at 96.60 by Friday.
Wow, that is a steep drop.
It really is. Brent crude followed that same trajectory, settling at 103.54.
Which, acts like a massive pressure release valve for the entire global financial system.
Oh, for sure. When oil drops that fast, it immediately alters the inflation math for bond traders.
That is the crucial mechanism. Because spot oil came down so aggressively, the 10-year Treasury yield compressed, falling to 4.558%.
And when the risk-free rate drops, it provides a very nice concrete floor for credit markets.
Right, we saw high-yield bonds advance to 79.91. Meanwhile, the U.S. dollar index ground a bit higher to 99.32.
And gold drifted slightly lower to close at 4,509.21. That was mostly as some of that immediate geopolitical panic unwound.
But let me push back on this narrative a bit, Mira. Was this actually a fundamental shift in the market's health?
What do you mean?
Or was this just a mechanical, algorithm-driven relief rally? Because yes, spot oil dropped this week, but we are still balancing on a knife edge of stale economic data versus real-time pricing.
That is a fair point.
The equities market priced in this massive sigh of relief because crude dropped over a period of 3 days. But the structural damage of those $100-plus oil prices for the past 2 months.
Yeah, that is already baked into corporate input costs and supply chains.
Exactly. You don't just erase a quarter of margin compression because oil had a bad Thursday.
That is a vital distinction, Daniel. The market trades on forward expectations. So a drop in spot oil feels like a victory today because it implies future relief. But you are absolutely right that the historical damage over the last 8 weeks hasn't evaporated. The earnings hit is still coming down the pipeline.
So to wrap up session 1, the past week gave us incredible resilience in equities, driven almost entirely by an energy sell-off and compressing Treasury yields.
But as we transition into what actually happened over the weekend, that resilience is going to be heavily tested.
Definitely. Let's take a quick mental breather, and then we will dive into a very heavy weekend news cycle. Welcome back. Let's open session 2. The core question here is,
What were the key weekend news events, and what are their market implications framed under our contemporary macro context?
Well, before you start breaking down the actual headlines, we need to set the table regarding liquidity.
Oh, right, the holiday.
Yeah, Monday, May 25th is Memorial Day. U.S. markets are closed.
That means we have a long weekend of very thin global liquidity.
And all of these weekend headlines are going to bottleneck into a massive data dump on Tuesday morning. That includes the Chicago Fed National Activity Index and consumer confidence numbers.
The market is going to have to digest a weekend's worth of geopolitics and domestic data in the first 5 minutes of trading on Tuesday.
Exactly. So keep that Tuesday bottleneck in your mind. Because our first and by far most critical event is the Hormuz peace deal.
This is the geopolitical pivot we have all been watching.
It is. By Sunday, May 24th, international mediators helped draft a memorandum of understanding aimed at ending the U.S.-Iran conflict.
Right, and those mediators heavily involved Pakistan and Qatar alongside President Trump.
This was the rumor that tanked crude oil on Friday afternoon, actually.
The reported terms of this draft include a 60-day ceasefire and the gradual reopening of the Strait of Hormuz to commercial shipping.
And the lifting of the U.S. naval blockade. In exchange, formal talks would begin regarding Iran's nuclear program.
Now, I am going to challenge the market's immediate relief on this one, Daniel.
Okay, I am listening.
Let's look at this through a game-theoretic lens rather than just reading the headline.
Right.
The idea that Iran is simply going to surrender its highly enriched uranium remains highly disputed.
Yeah, senior Iranian sources were leaking that to the press over the weekend.
Exactly. Giving up that uranium is a massive strategic concession that permanently alters the regional balance of power.
So can we really price in lasting peace when geopolitical brinkmanship as unhedgeable tail risk is still an active daily play?
No, we really can't. A 60-day ceasefire does not magically lower maritime insurance premiums.
Plus, the UK maritime trade operations reported that piracy alerts and harassment from small skiffs in the Gulf of Aden just flared up again on Saturday.
Yeah, the waterway is not fixed. And that tension between a drafted piece of paper and the physical reality of maritime security is exactly why energy markets are so fragile.
But let's shift from the geopolitical to the domestic. Because Event 2 is this brutal collision between the American consumer and the Federal Reserve.
Right. We have to view this through the lens of energy shocks as a delayed consumer tax.
Which finally showed up in the hard data.
It did. On Friday, we got a shocking preliminary May University of Michigan consumer sentiment dropped down to 44.8.
Wow. For context, that is an abysmal number.
And worse, one-year consumer inflation expectations jumped to 4.8%.
Ouch.
Yeah, the consumer is feeling the pain of those oil prices at the pump and the grocery store. But contrast that weak consumer data with the political theater that happened on Thursday, May 21st at 6:24 p.m. Eastern Time.
Right, when President Trump officially swore in Kevin Warsh as the new Federal Reserve Chair.
The dynamic there is fascinating. On one side, Trump explicitly stated during the ceremony that he wants the Fed to focus on economic growth and to curtail forward guidance.
He wants the economy to boom without the Fed constantly talking it down.
Exactly. But Warsh's immediate response was that he intends to lead a reform-oriented Fed specifically to tame inflation.
That underlying tension between the White House and the Fed was amplified on Friday morning around 10:01 a.m. Eastern Time.
That was when Fed Governor Christopher Waller executed a massive hawkish pivot.
He publicly stated it would be, quote, crazy to discuss rate cuts right now.
And he explicitly warned that if inflation unanchors, the Fed will need to respond with aggressive rate hikes.
Which is the ultimate fear for the equity market. It all comes back to central bank credibility as an inflation anchor.
Right. If consumers believe inflation will be 4.8% next year, they change their spending habits today.
Making that inflation self-fulfilling.
Exactly. And if Waller is floating hikes to stop that psychology, the discount rate is going up.
Which brings us to Event 3, the AI infrastructure arms race. You are probably wondering, if the consumer is collapsing, oil is volatile, and the Fed is threatening to hike rates, why is the NASDAQ still holding up?
Because the tech sector is completely ignoring the Fed right now.
Yeah, they are operating in an entirely different macroeconomic reality.
Let's look at Taipei over the weekend to understand why. On Thursday night at 9:36 p.m. Eastern Time, AMD CEO Lisa Su emphasized that their supply bottlenecks are resolving rapidly.
She also projected a massive 35% annual expansion for CPUs.
Then on Saturday morning at 5:01 a.m. Eastern Time, Nvidia CEO Jensen Huang confirmed exceptionally robust global demand for their current H200 chips.
And he heavily hyped up their upcoming Vera Rubin architecture as the most successful platform they have ever built.
And what's crucial here is the regulatory cover they're getting. This isn't happening in a vacuum.
Right. On Friday, U.S. Trade Representative Jameson Greer confirmed there are no immediate semiconductor tariffs coming down the pipe.
Additionally, President Trump postponed a planned executive order on AI, specifically because of concerns it might hurt America's technological lead.
So we are watching AI capex as a cycle-agnostic arms race. It is successfully fighting off the discount rate as financial gravity.
The structural physical demand to build out these data centers is so strong that it is simply overpowering the traditional mathematical models.
Yeah, models of how high interest rates are supposed to compress tech valuations.
The spending is going to happen regardless of what Kevin Warsh does with the federal funds rate.
It is the only thing holding the ceiling up for the S&P 500 right now.
Well, before we close session 2, we need to briefly touch on Event 4, which is Russian escalation.
Right. Over Saturday and Sunday, Russia launched an enormous attack on Ukraine involving 600 drones, 90 missiles, and notably, the hypersonic Oreshnik intermediate-range missile.
The deployment of a hypersonic weapon is what matters for markets here. Because it evades traditional missile defense systems, this reckless escalation forces a complete rethink of European security infrastructure.
It keeps European instability extremely high.
And it guarantees that defensive haven assets like gold will remain structurally supported by institutional flows.
Even while U.S. equities try to rally on AI euphoria.
To summarize session 2, we have an exhausted consumer buckling under inflation, a Federal Reserve threatening to hike rates, an incredibly fragile memorandum of understanding in the Middle East, and a tech sector that is physically building the future fast enough to ignore all of it.
That is the macro backdrop you have to navigate. Let's take a quick breath before we look at the week ahead.
Welcome back. Let's move into session 3.
The question is, what should we watch in the coming week?
Looking at the calendar, remember that Monday is dead air due to the holiday. The fireworks really start on Tuesday, May 26th.
Right. We have that Memorial Day delayed data batch. That includes the Conference Board Consumer Confidence, the Chicago Fed National Activity Index, Case-Shiller home prices, and the Dallas Fed Manufacturing Survey.
The Chicago Fed Index is going to be heavily scrutinized because it gives a broad measure of economic activity and inflationary pressure.
That is a lot of economic reality hitting an empty room all at once on Tuesday morning. What is the rest of the week looking like?
On Wednesday, May 27th, we have Fed Governor Lisa Cook speaking specifically on AI, the economy, and the financial system.
Given how AI is single-handedly holding up the market, her regulatory tone is going to move the needle.
Thursday, May 28th brings the U.S. Q1 GDP second estimate alongside April personal income and spending data.
Friday, May 29th is the Baker Hughes U.S. oil rig count, which takes on new importance given the Hormuz deal.
And finally, on Sunday, May 31st, Fed Vice Chair Michelle Bowman speaks in Reykjavik.
That is an incredibly dense schedule for a short 4-day trading week.
So, to everyone listening, I highly suggest you grab a drink and take a deep breath tonight, because preparing for Tuesday requires a special kind of zen right now.
It really does.
Think about it. We are heading into a week where our portfolios depend on a mostly finalized Middle East peace deal that somehow still involves negotiating over highly enriched nuclear uranium.
And we have a brand new Fed chair who might just decide to hike interest rates on his very first day in the big chair.
It is entirely absurd when you say it out loud like that.
But hey, at least we can always count on Jensen Huang hyping up microchips in Taiwan to keep the S&P 500 afloat.
Right. So set your alarms, try your best to ignore the hypersonic missiles flying over Europe, and remember, if AI doesn't manage to magically solve inflation by Tuesday morning, we can always just launch our portfolios into orbit on SpaceX's newly tested Starship V3.
Speaking of AI magically solving things, I want to leave you with a provocative thought to mull over as we head into Tuesday's Open.
Okay, what is it?
We just spent this entire deep dive establishing that AI infrastructure is the only thing keeping this market afloat against the gravitational pull of rising interest rates.
Right, the cycle-agnostic arms race.
But what happens when the massive, insatiable power demands of these new AI data centers collide with the extreme fragility of global energy markets that we have just witnessed over the last 2 months?
Oh, wow. That is the ultimate collision course. You cannot build a data center without baseline power.
Exactly.
Wow.
We are looking at energy access as an AI infrastructure bottleneck. If this paper peace deal in Hormuz fails and physical energy prices spike again, the cost to power this AI revolution might become the very thing that derails the tech sector's margins.
Think about that as you watch the NASDAQ this week. Well, let's see how we are putting our money where our mouth is. Let's transition to our bonus session, paper trading.
For those of you new to the show, we run a public paper trading experiment. The goal is to see if our macro narrative analysis actually generates alpha in a simulated environment.
Our current status, as of the Friday, May 22nd close, is that our portfolio value is sitting at $10,993.81.
That is a 9.94% return since we started, which is currently outperforming the S&P 500. The S&P is up 4.88% in that same time frame.
Not bad at all for navigating a global oil shock and a U.S. consumer slowdown.
Definitely. Let's get into the decisions for the upcoming week. For my trade, executing at Tuesday's close, I am deciding to sell $390 of XLE, which is the energy ETF.
Okay, and what are you buying?
I am going to use those proceeds to buy $1,090 of XLK, the technology ETF.
Walk me through the justification for taking off energy exposure right now.
It comes down to the geopolitical risk premium. The Hormuz peace deal, even if it is incredibly fragile and contested, fundamentally breaks the immediate geopolitical oil premium.
Right, that premium has been aggressively propping up energy stocks.
Exactly. That makes the energy sector a massive downside liability right now if the ceasefire holds.
Yeah.
Meanwhile, the AI cycle has been completely de-risked in the short term by Jensen Huang and Lisa Su's comments in Taiwan, combined with President Trump delaying the AI executive order.
I see.
So I want out of oil and deeper into tech. What are you doing with your sleeve of the portfolio, Mira?
I am actually in complete agreement with that direction. For my trade, I am selling $1,000 of XLE and buying $1,000 of XLK.
And your justification?
Well, to add to what you said, the delayed consumer tax of the energy shock is finally abating. XLE is simply a liability as that tail risk dissipates.
Right.
Moving that capital to XLK allows us to capitalize on the unimpeded AI capex expansion. Tech is entirely ignoring the Fed's hawkish financial gravity right now.
And you want to ride that momentum rather than fighting it.
Exactly.
Excellent. So aggregating our rules and constraints, our final executed decision for Tuesday's close will be to sell $1,045 of XLE, which represents 9.5% of the portfolio.
And we will buy $1,045 of XLK, also representing 9.5%.
And as a final reminder to you listening, this is strictly an internal paper trading experiment for educational purposes.
Yeah, it is not financial advice, and past performance definitely does not guarantee future returns. Do not copy these trades blindly with your own capital.
That brings us to the end of our analysis. Thank you for joining us on this deep dive.
It is going to be a fascinating, volatile week.
We would love to hear how you are navigating this tightrope, so drop a comment below and let us know your thoughts on the upcoming week or our portfolio moves.